The market doesn't know what keeps you up at night. It doesn't know when you want to retire, and it doesn't know how old you are. The simple truth is, the market doesn't care. But if you care, you've tuned into the right place. You're listening to Investor Resources, bringing clarity to the confusing world of finance. Here are your hosts of Investor Resources, Don Creech and Perry Sykes.
I'm Don Creech.
And I'm Perry Sykes, and welcome to the Investor Resources Podcast.
So we titled this segment Depressing Rates, because if you were in the market for a mortgage, you're probably depressed and you're waiting and you're looking at credit card balances. You want maybe you need a new car, or you saying, I can't do that, I'll buy a used one. But even those loan rates are expensive. I'm just kind of stuck where I am. And we're basically waiting for the Fed to depress rates, because that will make all of us happier. If the Fed depresses them enough, we won't be depressed anymore. How about that?
Across the board. Yep, that's exactly what we're waiting for. We need those rates to come down, kind of loosen up that the ability to borrow capital. That's what we're looking for.
So there's real concern now that consumers are finally getting the impact of higher rates and the higher cost of living. Inflation's coming down, but it's on a slow lag. It takes a lot of time for high rates to change investor behavior, especially when you start the whole process with the government giving you a boatload full of money to hide the fact that they're inflating the economy.
Right. Let's just dump some cash on this across the board and see how it goes. Of course, we got a load of inflation. And of course, we got some hot consumer spending, which ever since COVID, the Fed's been trying to get the consumer to slow down, and they may have finally gotten there, right in tandem with now it's time to start dropping those rates. But it's because the consumer's finally showing signs of, this is really getting expensive. The day-to-day expenses now.
Well, it's certainly visible in the data for the lower household income areas. They've been squeezed quite a bit, and it's starting to show up in other segments. Even the higher income segments of our population, and certainly the global population, are already feeling the impact. In fact, in this weekend's email, and the articles that I read, China's high income consumers are pulling back on luxury goods, and it's hurting the European economy, where high-end luxury stuff has basically been sold to China. And they're saying, right, we're not so sure we're going to do that. And we're seeing that impact here as the really expensive stuff is starting to stay on the shelf longer. A company like McDonald's is feeling the impact. They went back to the $5 meal deal because sit-down restaurants were becoming too expensive for the average household of four to go out for dinner. The $5 deal was supposed to be the alternative, but even that on the lower income household range is not very acceptable. So the higher rates are taking a toll.
Like you said, the consumer is being affected enough that McDonald's went back and said, you know what, this is really substantially hitting our revenues. People are not coming. McDonald's was the go-to cheap meal. And then all of a sudden it wasn't inexpensive enough to make a difference anymore. So they had to go back and cut prices. And so it's a direct signal that the consumer was definitely being affected finally by inflation and day-to-day living costs, and McDonald's had to make that adjustment right now, or start missing out on revenue. So they had to cut prices right away. So it is definitely real. It is definitely hitting the consumer's bottom line, and that's another signal that it's probably time for the Fed to go ahead and begin cutting rates safely, because finally they've got the consumer reined in, not because the consumer wanted to, but it finally just got too expensive.
Well, there's several other areas that are being impacted, particularly in the lower income households. Credit card delinquency is starting to rise. Car loan delinquency is rising. And just as far as car sales are concerned, EV sales are collapsing. And upon surveying the people who were potential buyers, they basically are saying they're just way too expensive and we cannot afford them. And
Right.
we need, if you want to do that, even with the rebates, if people are saying this is too much money, our household can't survive with this kind of purchase and commitment. So we either buy something smaller or buy a used car. Used car prices are finally coming down. The inventory
Correct.
is catching up with it. The surplus is building. So that's helping. But let's see, housing. Housing supply remains in a critical level. The supply is still short.
Yep.
It is improving as far as new construction is concerned, but those are smaller homes on smaller lots, or primarily it's multifamily dwellings, which means it's a lot of apartment houses. We get
Right.
more apartment houses, rents will finally start to soften a little bit. And I saw an article this morning, which I didn't finish, but basically, we have more young unmarried adults living with their parents in their 20s than we have since the 50s. They can't afford to get out of the house.
Right. Right.
That's
Just
a
their
problem.
wages.
That's depressing.
Yep, their wages won't support it, and uh, it's good news that those changes are coming in. But like you said earlier, Don, those are long flow changes. Those take a while to get into the first of all the inflation numbers, but they also take a while for that inventory to come online and actually give the people trying to move out an opportunity to have more inventory, just a place to go where they're not constantly being bid up in price, which is what's going on right now because the inventory is so tight. Those changes don't happen overnight, so it's good that it's heading in the right direction, but that's going to be a number of years before that supply and demand can equalize a bit.
Well, one of the other lag effects that comes from that is if you can't afford to move out of your house, the odds are you're not getting married and starting a family. And it's
Sure.
family formation that generates broad consumer consumption that keeps the economy growing. If you don't think
Yep.
that's true, just look at Japan post 1990. And now look at China. They're facing the same kind of demographic problem. They do not have family formation, and family formation is essential. You just think about it. Family formation means I need housing, we have babies, and now we need a whole new set of furniture. The babies get older, and now we need bigger furniture, we need bigger toys, we need bigger clothes, we need a bigger
Yep.
house, we need a backyard. All these things are driven by the demographic demand, and that demographic demand has been pushed further out because of the high interest rates slowing everything down. And we haven't had a recession yet, though we could argue we've had a rolling recession in different industries. That
Right.
doesn't qualify as an economic recession. That's what we talk about in portfolio management, is that there are leaders and laggards. And if you happen to be exposed to an industry that's going through hard times, why is it in your portfolio?
Right.
Let's wait and watch for things to turn around. When they start turning around, now we want to pay attention to when can we get on board that has less risk probability. The risk never goes away. The issue is, what are the probabilities of taking my entry point at this time, as opposed to just riding through a malaise that may last for years. And in the case of Japan, it lasted for decades. It's still underway. And in
Correct.
China, it looks like it's underway now that they really messed up on their COVID call, and they may not ever be able to recover from the mistakes they made with command and control in COVID. I mean,
Correct.
the industrial community and their real estate business, which is supporting their global impact on the global economy, it's all unwinding. Well, we don't want to do that here. The Fed is going, well, this week's announcement from the Fed is expected to say interest rates will come down beginning in September.
Soon. Yeah.
And bond investors, not all of them, but many bond traders are betting that it will be too little too late. And by the end of the year, the Fed will make two more rate cuts, more than currently expected by the Fed or implied by the Fed. So
Right.
we're going to see a change. The issue is, will they avoid the recession, and will it be mild? So far, governmental people dealing with this issue are saying we've managed the soft landing, no recession, but it looks like that may be a premature assumption.
Not completely out of the woods yet here. And again, these are long flow issues, and it's easy to say, to declare a victory and try to walk away and say, hey, that's it, we beat it, we brought inflation under control without a recession. Didn't we do great? Until that recession finally hits a little bit later than anyone thought. So it's you've got to stay aware. You've got to keep an eye on exactly what's going on out there, because we could still easily have a recession with the current economic conditions we have right now. And it's like I said, Don, we'll see. Are these rates too late? Do they wait too long? And those are all things no one knows. We're going to have to wait to watch that unfold. And no one likes that. So everybody begins making declarative statements now. We made it. There's no recession. Isn't it great? Let's move on. Not the case yet. So it's time to be very watchful and willing to adapt to what's going on when it happens, because we still have no clue as to what the real outcome of this is going to be.
We're making the assumption that when the Fed cuts rates, the bond market will respond. Bond rates are a mathematical process. So it's
Right.
not so much supply and demand. It's the largest, the treasury market's the largest trading market in the world. So assuming the Fed cuts rates in September, we expect that bonds will begin to appreciate, ending the nearly 4-year bear market in bonds. That's positive. But the error that many investors make is that when rates come down, the stock market's going to roar. That's a dangerous assumption. It typically will, because investors get sucked into the optimism of a lower rate economy. But typically, once the Fed begins a rate cutting cycle, they're doing so because the economy is in serious shape.
Right.
And the market will only continue up for a limited number of months. Typically, within 6 months after the rates begin a rate cutting cycle at the Fed, the market enters a bear market that reflects the recession that is underway, trying to figure it out how deep it is. So
And that's what the
don't get
reality is, right?
yeah, don't get overly excited about the fact
Yep.
that rates are going to come down, and all I need to do is dump money in the market. Retail investors are still sitting on the sidelines in bulk. I mean, there are people who are investing. If you're watching this, maybe you're one of them. You have some money in your 401k. You're saying things are going to be okay when the Fed cuts rates. But there's a period coming after that that is going to be full of danger for anybody who's concerned about the value of their accounts, because a drawdown post rate cutting cycle can be quite severe. Have a
Correct.
plan.
And especially if you're just a broad market investor. If you're just buying the index and forgetting about it, that's when you can really get caught up in the down cycle. There's generally going to be parts of the market that are very out of sync, and they're not going to do well at all. Best to avoid them if you can, and not just buy the market and hang on for dear life. That may take longer for recovery to set in for everyone, and parts of the market may not be impacted anywhere near as much. That's why you need to be a little selective, and that's why at times like that, that's when index investing might not be your best friend.
So if you have questions about what to do with your portfolio, you would like us to take a look at it, it's a free offer. The follow-up slide here has our contact information. Give us a call or send us an email. We don't need to see your whole account. We just need to know what you own. Take a look and see if what you own is classified as a leader or a laggard. And then you can answer the question, do I really want to own something in my portfolio with no stop loss provisions on how bad it might be?
Indeed.
We look forward to meeting with you, talking with you. We do all this online. Have a great day. Subscribe to our podcast and sign up for our webinar that we're doing this weekend.